when we unified the exchange rates in June 2023, I saw it as ill-advised, and I made that very clear, because data and historical occasions have proven one thing, that number one, we are an import-dependent economy. That's the truth of it. Now, some analysts might tell you, we are not even importing enough relative to our population, relative to our GDP. That's a matter of playing with numbers. Because every ratio you talk about is playing two things against each other, the numerator and the denominator. Any of them changes, the ratio will change. All right? And comparing ratios also can be misleading. Because if you compare Kenya and let's say Ghana with Nigeria, you are looking at bases that are bigger in Nigeria. And so if the top is bigger than the top in Ghana, but of course relative terms is smaller, you will now tell me that Nigeria is not importing enough. So for me, well, let me say, stay with the academia. We call it dubious analysis. Okay, that's working from the answer back to the question, instead of from question to the answer. Now, the reality is this: when it comes to exchange rate management, there are 12 factors that move exchange rates. And then we ask ourselves, where is the position of those factors today in Nigeria? Now, also, we look at the big place of external reserves. And then we interrogate that and say, okay, how much do we have in the pocket? When you allow the market forces, the interplay of demand and supply, which is just one out of 12 factors that should move the exchange value of the currency, to now be a matter of willing buyer, willing seller, against our culture, what we likely get is a perennial loss of value by the local currency. And why do I say that? It is very simple. Now, the currency of any country plays 4 basic roles. Use money to make purchases, use money to pay expenses, use money to ensure security, and then you also invest money. Okay? But when you look at our economy today, unfortunately, Naira is the legal tender, but we have dollarized the economy in such a way that the US dollar plays far beyond those 4 traditional rules of money. So now, we not only use it in pricing services, pricing assets, we also use it now as a hedge. But as a hedge, it also plays several different roles. Hedge against inflation, hedge against the exchange value of the Naira, hedge against insecurity. So it has gone beyond the 4 traditional roles money should play. Unfortunately, it is playing that role in the jurisdiction that doesn't belong to it. Okay? So the question then is, let's look at the pocket. And I always cite China. When you check the external reserves of countries around the world, China is always number 1. At the time, China had over $3 trillion external reserves, but they never floated their currency. The US doesn't need big external reserve because we all use their currency for everything we do. Go check the data. External reserves for US is always moving between 160, 170, 118 billion dollars to maybe 122 at the maximum. Go and check that in the last 10 years. So they don't need deep pocket of external reserves because the rest of us in the world, we use the US dollar for international trade, and the aberration in Nigeria now, where we have dollarized our economy. So the way it goes, therefore, is that for me is the big elephant in the room. Yes, no doubt, our inflation rate is inching towards 30%, and we are projected that probably will settle at 23.47% end of the year. But unless we take some hard decisions, now let me put it in context this way. We say that our president, and I respect him for that, is bold and also confident. All right? But when we bring the word courage into that, courage is what it needs at this point in time to look at a particular policy that is not working. I have the courage enough to say, look, we need to correct this. Governments all around the world make corrections to policies that are not working. If the outcome of a policy is not giving you what you expect, you go back to it. For what you call regulatory impact analysis, RIA, means that anytime you introduce a regulation, if it's not producing the right effect, you return to the drawing board. You analyze the impact and then make adjustments. I think it's a time for us to adjust our policy on exchange rate management. As at yesterday, the dollar was already knocking on the door of 2,000 Naira to the dollar. When Economic Intelligence Unit predicted that 4 months ago, I challenged it. I said, never. Naira can't get to 2,000 Naira to a dollar. This your own outlook is nonsense. That was my reaction as a professional economist. But looking at what the market is saying now, I'm beginning to wonder that even the 2,000 Naira to a dollar they predicted is something that might happen within this first quarter of the year. Meanwhile, their own outlook was for end of the year. So now, that's on the one side. So the question then is, if we don't have sufficient reserves in the pocket to pay our import bills, which of course later data available put at 1.88 trillion Naira per month, dollar equivalent using the old rate anyway, is $2.303 billion per month that we need to pay for imports. So now, the other area where I think policy needs to be corrected to deal with this, and the challenge we are facing generally with prices of all commodities, is the reference exchange rate for computing import duties. If you follow the market, 4 times this year, and this is just February, the central bank has advised the customs changes to that rate. 4 times already. This is mid-February. So it means then that the key issue here is to ensure that when certain things are working contrary to expectation, we should return to the drawing board, interrogate the issues, and make necessary corrections. If you are import dependent and you keep marking up the exchange rate for computing import duties, you are piling more cost on anything imported, and of course, whether you like it or not, it will pass through to the final consumer. And that is what is creating inflationary pressures and the heat we are feeling all over the place. So if we bring it home to real estate, the question then is, how are these developments impacting building materials to start with? An investor interested in development of new real estate assets, of course, we naturally want to hold back. Now, for foreign investors that we think will be attracted when the Naira is floated, they also see that volatility as something that is not attractive. For a portfolio investor, there are 3 basic things considered. The first is safety of the principal. The second is the return. The third one is liquidity. In which case, liquidity now talks to, if I bring in my dollars to invest in Nigeria now, when my investment matures, will there be liquidity enough for me to take it out? So those are the things we must put into consideration, and then talk about what are the ways out. Of course, the slides I prepared has a lot of data, also interpretation. So that's why I'm not talking to all of them. If you look at our stock market, again, some measure of volatility has crept into that. It looked very good up until end of December 2023, looked very good up until the end of January this year. But when I checked as of yesterday, return on the stock market, 36.94% so far. Assuming your portfolio matches the return on that market, it looked very good at 36.94%. That probably, you compare to the rate of inflation, latest data 29.9% for January, it will seem like you have some measure of gain there. But by the time you look at the MPR, and that is what I think is a real headache for the central bank governor and members of the Monetary Policy Committee, they will meet next week. Typically for central reserve banks, when you look at MPR for us today at 18.75% and the rate of inflation, the natural thing to do is raise the policy rate so that you reduce the negative interest rate implied by the inflation rate. But if you do that in today's Nigeria, we know that what that means. Because by all means, that is going to also trigger fresh inflationary pressures to compound what you have presently. So that is what will be advised by orthodox monetary policy. So that if they choose to maintain the rate where it is, the question there will be, How do you deal with the challenge of money outside the banking system? 3.4 trillion naira outside the banking system. Okay, so how do we deal with that? How do we deal with money supply? It's multiples of tens of trillions of naira and several other challenges. So for me, the central bank governor currently of Nigeria has the most difficult job in the world. So, and of course, capital importation, yes, interesting. The fourth quarter of 2023, the data just came out, showed that, there was an upturn in capital inflows into Nigeria. Very interesting. One of the 12 factors that caused exchange rates to move, we call it capital flows. Okay? So, yes, more money came into Nigeria, but when you now pair it, you find that 59% of the inflows was actually loose. So, which means it is not so much as the preferred one, FDIs, and even the one that can bail you out in a time of emergency like this, which is portfolio investment, is not also big in that number. So that means there are still some things we need to interrogate and change in our policy environment to make portfolio investments to come. And my recommendation is this, of course, the panelists will also deal with this issue, that we need to fix the exchange rate officially within a defined band. If we continue with the present practice of floating the Naira, we can simply say that it will float to the heavens. So a summary of the Finance Act signed when President Buhari was about leaving office, which of course becomes of effect now. Also, of course, what are the drivers of the outlook? What do we expect? All of this will keep changing. Because in our own expectation, we look at parallel market average for the year, we set to at 1485. But that is premised on some assumptions. One of which is that as a government that is dynamic and responsive to interpreting what is happening, and therefore responding to it, that they probably tinker with the policy and bring some measure of stability to that market. We're looking forward to stability first quarter of this year in the FX market. But as it were, that might not happen until we get to the second quarter. In which case, by the time we get to end of March, we interrogate the drivers of outlook and then form a new one that we'll be discussing thereafter.